Hey guys, welcome to the Atlanta Landlord Luncheon. I hope you're doing well today on this October morning. So we are excited to bring you this new format where we can bring you monthly education, market updates, and hopefully more networking events to come. So the goal of the Atlanta Landlord Luncheon is to really help inform and educate you so that buy and hold real estate investors can build long-term wealth. You're welcome to follow us on Facebook, LinkedIn, and YouTube. You could just search for the Atlanta Landlord Luncheon and be able to find us there. But I'm excited for the speaker we have today, Kristi Cobb, to share with you about tax strategies for real estate investors. I know when I speak with a lot of new investors, they're not really aware of the tax advantages that are available for them by owning rental properties. And so we thought this would be a great opportunity to have somebody on to share about the tax advantages that are there. But I do want to share with you some upcoming speakers that we have. So in November, we're going to have Amanda Riedling with Georgia Wills Trust and Probate to share about ownership entities for real estate investors. I know it's a common question we get for new landlords is, should I own this property in my name? Should I put it in LLC? Should I use a trust? And really the answer depends on your goals, your strategies, and what stage you are in your investing journey. And so Amanda will be on to share with us about the pros and cons of each of those. And then we also have Ted Steinkamp from with Advana IRA, sharing about how you can use your retirement funds to invest in real estate and the different strategies that are available through using your IRA. So we're excited about the upcoming speakers that we'll have for you. Just want to do a short introduction. My name's Matt Martin with PMI Georgia. So we manage over 500 in rental properties throughout Metro Atlanta. If you have a single family home, duplex, a quadplex, small multifamily, we'd love to talk with you and see if we can help you build wealth long term through managing those assets. So I'm going to hand it over to Chip Cagle at Longhorn Investments. He's at Hobnob Restaurant in Dunwoody. And so, Chip, I'm going to hand it to you.
Hey, so let me get this adjusted here, make sure all of us are on this screen. Oh, that didn't work out so well. Hold on just a second. Now, how are we? Yeah, pretty good. Be with me just a second. Hey, Chip Cagle. I'm here at Hobnob Tavern in Dunwoody, and we are having the live portion of the Atlanta Landlord Luncheon here. So you're welcome to join us each month if you want to meet other investors in person. So Longhorn Investments does fix and flip and new construction. And on the fix and flip side, we can do 100% of your purchase and rehab. That's 100% of your costs up to 70% of your value. And we can even go to 75% of the value if you get pre-approved for a rental refinance. And I can help you with that. It doesn't mean you have to keep it as a rental property. It just lets us know that in the event you did, we'd get paid off. So give me a call. We can discuss, go into more details about it. Phone number is 404-216-5599. Or my email address is ccagle@longhorninvestments.com. Thanks.
All right. Thank you, Chip. All right. I'm going to welcome onto the stage Kristi Cobb, who's our speaker today. But first, I'm going to hand it over to Chris. He's going to do the introduction for Kristi.
Hi, everyone. I'm Chris Littleton with PMI Georgia. I'm also a real estate investor, and I've often said that it is probably one of the best tax advantages you can see in business opportunities for real estate and real estate, buy and hold real estate. I often say that the wealthiest people in the world may have not have made their money in real estate, but they certainly hold a lot of their wealth in real estate, and we're going to cover a lot of those reasons with Kristi today. So with that being said, Kristi's been our tax advisor and CPA, and we've been working with Paragon for quite a while now. She does a good job because she's very patient, but she's very knowledgeable as well. Because if anyone doesn't know, me and my wife are in business together, so it can be a struggle sometimes to get on the same page at the same time and run. And she is very helpful with that. But Kristi, I just want to say thanks for joining us today. I've looked over the information about this, and you're right on point when it comes to all these tax advantages that we're all looking for, and the tax strategy and planning that you help us with. It just speaks volumes for us and me being in this business. So with that being said, Kristi, give us all that nourishment of knowledge that you're going to provide for us during the landlord luncheon.
All right. Thank you so much for having me. I think what I want to start off with is the fact that every situation is different and every taxpayer has a different situation. So there's so much information out there, you know, with social media and TikTok and YouTube. And I have clients ask me all the time, I saw this the other day, and is this true? And it's very important to have an advisor on your side, because something that you hear may be true, but it may not be true for you. So every taxpayer situation is different. Every real estate investment is handled differently depending on if you're just an individual real estate owner, real estate professional. So it's important to know that not everything can apply to everybody. I heard you mention something about LLCs, and you're going to have someone talking about that next week, which is really important. It's always often a good idea to have real estate in LLCs, but the only reason for that is for liability purposes. It has no effect on your taxability at all, because LLCs can be taxed in multiple different ways. So when someone asks me, should I buy this and put it in an LLC? It depends. It's not going to change your tax situation, most likely. The other thing is, there's lots of ways to invest in real estate. And so if someone says, should I get into real estate to help me on my taxes? Again, that should never be the only reason you do it. And real estate is a great way to diversify your investment portfolio. It's a good way to have assets other than stocks and retirement plans. It may not help you on your taxes immediately, because there are limits on tax returns. So if you're having a really, really good year and your adjusted gross income is like $400,000, whatever, you're not going to be able to take a tax loss on your real estate properties unless you have a couple other things. One, you're a real estate professional. Two, you have passive income that it can offset, that's profitable. So these are things, like I said, it's really good to talk to somebody and say, this is my situation. How can I offset this income? So there's multiple strategies for owning real estate. And what's right for you depends. There's the short-term Airbnb, right? People buy things, fix their places up, rent it as an Airbnb. There's limitations on Airbnbs that can't be, you can't get as many deductions necessarily. One, when you fix it up and you buy all the furniture and the improvements, those are actually assets that are going to be depreciated over time, and they're not immediate expenses. This is a good thing in the long range, though, because when you sell it, now you have higher basis and less gains. So it's important to understand that even though you might not be deducting those appliances all this year, it's going to help the value of the property down the road. Midterm rentals is a big one too, where you have an Airbnb, but you rent it to insurance companies like for 3 months. And that's because somebody's had a claim in their house, and you can get a renter in there at a higher rent than a long-term, but you've got them for 3 months. That's a really good strategy. There's, of course, the long-term rental, where you have just the typical lease for a year, 2 years, 3 years. It's not going to make maybe as much per month, but it's a guaranteed income. The vacation home. If you buy a second home that's a vacation home, you probably are not going to be able to deduct everything. if you use it too much. So you're only allowed to use a second home 14 days a year and then be able to deduct losses. If you go like a couple months a year, you can't take losses on your vacation home. The other big ones, buy, fix up, and flip. Very good investment. It's quick turnaround, quick cash, but this is this is taxed at the highest rate because it's considered a business. It's not considered a rental property. It's considered, I have a business, I fixed up a house, I turned it around, short-term gains. So you have to be ready to pay a higher tax on flips. Let's see. Depreciation recapture. So let's say you've had a house for 10 years, rental property, and you go around and you sell it. And everyone's question is, what are my gains going to be? It doesn't matter how much you owe on the property. That is not how capital gains are calculated. It is basically how much did you buy it for, how much did you fix it up, and how much did you depreciate it. So let's say you depreciated it down to 100,000. You bought it at 200, but now it's only 100. Now the gain is calculated on the lower basis, and you have to pay tax on the depreciation recapture. See, all this stuff is complicated. It's not something that I would ever recommend doing without an accounting professional in your corner, because I've gotten clients that have had rentals that haven't depreciated for 5 years, and now all of a sudden they're having to pay gains on depreciation they never took. So this is something you really want to pay attention to. I had mentioned that not everyone can take a loss. So the loss you're limited to in a year is $25,000 if you're married filing jointly, and it's only if you make under 150K for adjusted gross income a year. So a lot of times real estate investors make way over that. That doesn't mean the losses go away. You don't lose those losses. They just carry forward. So again, when you sell the property down the road, now you have all these carry forward losses that are going to help offset that sale. So it's not necessarily a bad thing you didn't take it that year, because it's going to help you down the road. Real estate professionals, however, are not limited to that loss. One of the things that requires that you be a real estate professional is that you work in the real estate profession and that you log at least 750 hours a year in that business. I've never had anyone audited and them ask for that log, but just be aware that if you're audited, you're going to have to prove you put that much hours into your business if you've been taking all the losses possible. And then I mentioned you can offset other passive income. So what that would mean is, let's say you invested in a partnership that you get a K1 for, and you're not involved in that partnership at all. It's just an investment. Well, that's passive income because you're not actively participating. Let's say you have a huge profit in passive income on a K1, your losses will count against that and bring those that income down. So that's a good, if someone has a lot of passive income, they may want to go out and buy real estate to have an offset. One thing that is something that you can also keep in mind, let's say you have a very profitable business and you're thinking, I am going to buy a building and put my business in it. Okay, so now you're buying commercial property. You want to rent your business to the property. I always say keep the property out of the business, open a separate LLC. And the reason is, if something happens at that building, you don't want them to be able to sue your business. You want them to only sue the LLC that owns the building, right? Otherwise, they can take all the income you earn in the business that resides there. So it's important to keep real estate separate from your businesses. A good thing to do if you buy commercial property is get a cost segregation study done. What this does, okay, so let's say you buy commercial property and it's $500,000. That commercial property gets depreciated over 39 years. That's not very much money every year. if you get a cost segregation study done, they come in and they break up that building, and they go in and they say, oh, here, these appliances are 5 years, or here's furniture, or here's bookshelves, the flooring, the parking lot. And they break the building into all these little sections of years that are shorter than 39 years, which gives you more bang for your buck against the income that you have that year. So that's a very good thing to do. People often ask, how do I get out of capital gains selling a property? If it's your personal residence and you've been there 2 years, you usually don't have to worry about it because you have a $500,000 area, if you're married filing jointly, that you'd have to go above to have gains. But investment property is always going to have capital gains if you sell it for more than you bought it for. The only 2 ways to get around that I know of is Section 1031, which is you sell that property, you put all the money straight into escrow. You cannot touch that money. It has to go to a 1031 escrow account, and you buy a new property with that money. So it defers the taxes. Doesn't mean you're not going to owe it down the road, but it defers it for that property. The only other way is you just hold on to that property and you leave it in your will to your beneficiaries. And the reason that is really the best one is when they inherit that property, they get the step up of basis of what it is worth that day at death, and you lose all of that gain up until then. So you bought it at 100,000, you die, and it's worth 500,000. Now your beneficiary's basis is 500,000. So honestly, unless you really don't want property, or it's a property you don't like, or you want to get something else, keep hanging on to real estate property is really a good thing for your portfolio and for your beneficiaries, if that makes sense. All right, so I've been talking a lot and talking really quick. Chris, do you have anything?
Well, I think you covered a lot. I mean, I would like to say it's wise to always touch base with your CPA.
Yes.
when you're looking, or when you're looking to buy real estate, and tax and actually having tax strategies, which me and Donna we try to apply our tax strategies with you as often as possible. Buying and selling of real estate, and how it will affect you in the long run, and and being able to depreciate that assets. I think you covered the basis pretty well. As you own real estate, I always say it's an ideal investment. You get income, you get depreciation, you build equity over time, the property appreciates, and you can leverage those things. Can you talk a little bit about leverage and how that may be how that may affect your taxes as well?
Yeah, so if you buy property and you get a mortgage so that you're not just out cash, then basically your tenants are paying your mortgage. And if you pay your mortgage down faster than is required, then you're gaining equity faster. It's not anything out of pocket. I mean, you want rent to cover your expenses if possible. What people don't realize is the cash flow and the taxable income are very different, because the mortgage payment isn't deductible, only the mortgage interest is. So the leverage concept is, don't use all your cash up, use somebody else's cash and have the rent pay for the loan. And then that way you have more cash to buy more investment properties. And then as there's equity put in, as your equity grows in that property, you could always take out, a second to do more with it. But that's pretty much the concept. I know some people go and buy things if they find a really good deal and they pay cash because they have to, like more or foreclosures and such. But really, once the interest rates start going back down, I think mortgages aren't a bad thing, especially if you pay them down quicker than required.
So if someone has a property and they have a lot of equity in it and they refinance that property, pull that equity, and they go out and maybe use that money to buy another property, how does that new interest is still tax deductible? Correct. Is that how that works?
It is correct. You have to be careful because you have to make sure that the mortgage company knows that you're gonna use it for another property, I think. I mean, that's a kind of a mortgage question. I know people do that, but yeah, you would still be able to deduct that interest. It would be a matter of which property you deduct it on, though. That would be something that would have to be discussed.
Yes. Well, basically, if you're cashing out on a property,
Yeah.
you still get to use that interest deduction. And you're saying some of that future income off of another property you may have to claim that as well, or?
Well, you would have to claim, I mean, if you're using home equity to buy another property, it's still deductible, but that property is getting the income. So it would be a matter of having to determine how you're going to report all that.
Okay.
But the only time that home equity interest technically is not deductible is if you use it to like pay off debt or pay off your car, or it has to be used for home improvements or home ownership, and then it is deductible. Does that make sense?
So if you're acquiring a property from equity from another property, you need to tie that property's income and debt service to that loan amount.
Yeah, I would say once you buy the other one and get equity in it, I would try and transfer it to the correct property. That's
Yeah,
what I would do.
but it's a good way to offset income and grow your real
Yes.
estate portfolio.
Yes.
Yes,
Yeah,
that's what I was trying to get to right there.
Yeah, sorry,
So,
yeah.
leverage is a great thing, and I've always often said to people, it's like if you have a property, sometimes it's best to have it leveraged to the max than to try to build equity over time. But it's also nice to have properties paid off. So if somebody's asking me, what should I do? I'm like, well, if you can pay it off, pay it off. But if you have a lot of equity and you want to grow your real estate portfolio, it's a great opportunity for you to do that. And you can
Right.
offset that income that you develop with that loan amount on your taxes.
Right.
So-
And I think it depends what stage of your life you're in. Like some people, if they're using their rental properties as monthly income for cash flow for themselves, then paying off the mortgages is going to be better as they get older, right? So that they can pocket more cash. But it just depends where you're at in your life, what you're trying to accomplish. Again, goes back to not every situation is good for every person. And you have to kind of talk through what is it that I want to gain out of this? What's my long-term goals? Is it immediate tax deductions or is it long-term investment, right? There's different goals for everybody.
Absolutely.
Kristi, I got a question for you.
Sure.
So a common scenario that I come across is new landlords. So people who were living in their home, either they got a great low interest loan
Yeah.
and they're relocating, they want to hang on to it.
Right.
And some people right now, they bought in the last year or two and they just can't really sell it without taking a loss. So they're trying to keep it as they relocate as a rental. And maybe the property doesn't quite cash flow. Maybe it's $100 to $200 a month and then cash flow negative. And I try to interject, that there are other advantages, such as paper losses that can help offset some of those things. Could you just kind of walk, a new landlord through, what are some of those expenses that they could write off on taxes and how it might affect their personal tax return?
So they lived in the house, they're moving and now they're renting it, correct?
They're moving to a new
Yeah.
home.
So that was kind of what I was saying is like your cash flow is different than your tax return. So on your tax return, you're going to claim the income And anything out of pocket that you can claim, it's just, you can't deduct the principal. So you're going to be able to deduct the real estate taxes, the mortgage interest, if you're still paying for the lawn care, the pest control. But then you're going to also deduct depreciation, which is not money out of your pocket. So that's why a lot of times on tax returns, it looks like the property lost money, but you actually had a positive cash flow because the depreciation may be higher than the principal you paid out of on your mortgage. And that's when it helps you with your taxes if you're in a low enough tax bracket. The other thing that's good to point out to people that are moving and turning their primary into a rental is, as long as you lived in that property 2 out of the last 5 years, you don't have to pay capital gains on it. So that is something, I know builders that they'll build a house, like a really nice house. They'll live in it 2 years, they'll sell it, not pay any capital gains, and they'll move to the next house and they'll live there 2 years. So you can take that exemption once every 2 years. And so I don't want to move that often, but I know that there are people who do that to avoid the gains. So if they're moving out of it and they want to possibly sell it in a year or two, as long as they lived in it for 2 years, they won't pay gains on it. Does that make sense?
Yeah, absolutely. And so that's, correct me if I'm wrong, that's $250,000 per person,
Correct.
right? So for a married couple, if they lived in the house, they would not have taxable gains
On
as
500.
long as, yeah, as long as it's below 500,000.
That's
So
the gains, not the sales price of the home.
right,
Right,
yeah.
the gains,
So
yeah.
if it went up in value,
And you know, right now, nobody, maybe people in other states, no one in Georgia is making that much. You know?
right, yeah.
Unless they've been there a while.
But you know, so if they've been living in the home for 2 years, they move out and they rent it for 3 years. By that third year, they could still sell it and get that benefit
Yes.
of not paying any
Yes.
taxable
You
gains.
just
on
have to pay very close attention to the dates. Make sure you
Right.
close before that.
it. Right. But going back to the paper loss, so you said any expenses for that. So painting, new flooring, you mentioned kitchen appliances, all
Okay.
property
Yeah.
management fees, those are all tax deductible.
Yeah, so property management fees would be an expense. Painting usually is considered a repair. New floors would be an improvement and would get added to your asset list that gets depreciated. Roofs are improvements that are assets, any major structural, but repairs, maintenance is an expense that's deducted that year.
Okay, so there's a difference between maintenance and repairs and then
Mhm.
improvements.
Correct.
And improvements can be depreciated.
And they are depreciated, yes. And they're depreciated at different years depending on what it is. I guess one way to look at it is it improving the value of your house? I mean, obviously painting does, but it's not a long-term improvement. Painting can go bad pretty quick if you have somebody in there, you know, that's rough. But floors definitely improves your house. HVAC is considered an improvement that's depreciated. So it's just important that all that gets reported correctly.
Okay. Mm-hmm.
So you set a depreciation schedule over the many items that you're dealing with in your house, and that really helps you cash flow better over time.
Yeah,
So-
and it also, like I tried to explain, was it might not help you in the immediate, but when you sell a house, if you have more basis, your gains are going to be less. So it's always good to have improvements listed, because you know, money immediately, yeah, you might want that $5,000 deduction this year, but down the road, it's actually better to have to offset your gains.
Okay.
For taxes, yeah. And is there a limit on losses somebody can take? I guess you already mentioned that. So as
Yeah,
far as
so it's 25,000 for married filing jointly is the most you can deduct in 1 year for rental losses, but that's if you're under 150,000 adjusted gross income.
and are there any income requirements that change any of those thresholds of?
No, it phases totally out at 150, unless, like I said, if you're a real estate professional, then it doesn't. But I don't foresee that being something that changes in the future. That's been pretty consistent over the years. I know there's a lot of things next year that are up for vote that sunset, but I don't think there's any real estate stuff that's on the sunset list. So that's pretty accurate right now. Unless they increase the adjusted gross income higher because of inflation, I guess that's a possibility. But
Okay. Do we have any other questions?
Yeah, I was going to say, if anybody out there is watching, if you have a question, you can drop it in the comments. We can read through that. But Kristi, what would help you as a tax professional? How can new investors or seasoned investors help prepare? I don't know if QuickBooks is the right program to use, but how can they set their books up correctly to help a tax professional be able to work with them?
yeah, QuickBooks can be tricky with real estate unless you're really savvy with it. However, it does allow you to do classes. So, like if you have multiple properties, you can set it up so that you can assign income and expenses to a particular property and then print a report by property, because you have to be able to report everything separate, right? You can't just report it all together. Sometimes spreadsheets work great, but it's really important to keep track of income and expenses by property. Sending so one thing that I find is kind of confusing. Let's say one of your owners has like 4 properties with you, and they get one 1099 rent for the year. I have a way that I deal with that, but I have to split that 1099 up over the 4 properties. And then I add a 5th property that I put the 1099 to, and then I back it out and say allocated to 4 other properties. Because what the IRS wants to see is they want to see a matchup to that 1099. So I don't know if property managers have the ability to do 1099s per property. That would make it a lot easier. Does that make sense?
Yeah, we can actually do that, but we actually give our owners a cash flow report, which breaks down the expenses and the improvements for the year based on the property. So we generally, I think right now we're sending out 1099, but we send out the cash flow report, which gives you the improvements and expenses on the properties in general, because we're sending one lump sum over to an entity. Generally, if you're going to do something like that, you want to separate your properties. We always tell our owners, if they're going to own properties, if you want to manage them individually, or you want to manage them under one LLC, that being under one LLC, that's going to be the result of a 1099 for everything, and a cash flow report for your company. If you're going to own them individually and different LLCs, then you would get a 1099 for each property and a cash flow report for every property. But I always also tell people, when you get into this entity business, when you have to service those entities, and every one of those can be an expense. So I try to keep it simple. I try to keep everything under one entity and make sure that you have good record keeping.
Yes, and those cash flow statements from the management systems are very helpful. I get those for my clients and from you. But the other thing, since you brought this up, and the attorney might bring it up next year, but there's a new requirement for BOI reporting for every business LLC that someone owns. So like you mentioned, if someone has 5 properties and 5 LLCs, they've got to do that new BOI reporting through IRS for each
For
one of
The
them.
beneficial ownership.
Yes,
Yes.
yeah, they're
And that's all due by January 1st. So it's important to know you got to do that for every single LLC you
and
have.
it's a big fine if you don't, and I'm
It's
pretty
a
sure
big
they're going to be wanting to grab as many of those fines as they can.
Oh,
So,
yeah.
Yeah, just Google beneficial ownership if you got some LLCs out there you
Yeah.
haven't reported them
You
yet.
better make sure. Just
Yeah.
warning now,
Yeah.
everybody that's on here. If you've got LLCs, you got to make sure that you report them, the
Right.
ownership.
Very
Right.
important.
Yes.
Well, Kristi, this really great information that you've shared. One comment I want to make is, my dad is a big golfer, and he always said that the best wood in his bag is his pencil. And I think when it comes to real estate investing, there's a lot of new investors or people. They listen to podcasts, they're wanting to get in a property, or maybe they wind up with an inherited property, or they're keeping a property and they just don't know about the tax advantages there are for investors. But I think as you've shared, you really helped us understand that there's a lot of tax advantages out there, but it's also very confusing and complicated unless you're
Yeah.
working with a qualified professional. So I definitely encourage investors out there, work with a tax professional so that you can capture some of these savings that are built in, because the government does want real estate investors, and that's why there are these incentives out there to help mom and pop investors be able to hold real estate and build wealth long term. But Kristi, how can people get in touch with you? Could you share more about your business and how they might be able to get help from you guys at Paragon?
Sure. We're located in Woodstock, but we have clients actually all over the country. My email is Kristi, Kristic at paragonat.com. And the office phone number is 770-928-7229. We mainly specialize in businesses, so that's why we work with a lot of property managers, but I do have a lot of real estate clients. So
Awesome. And I'll be sure to drop those in the comments below these feeds so people can find you guys in your website.
Okay.
Well, great. Well, Chris, any final parting words for our audience today?
Well, just appreciate all of you joining us, and just remember, real estate is a marathon, not a sprint. If you're in it for the long haul, it's a great way to build wealth. So, thanks everybody.
That's
Great.
right.
Thank you very much.
So if you have a property you're interested in renting out, we would love to hear from you. So you can connect with us at pmigeorgia.com. We have tons of calculators on our website that you can request a rental analysis. You can fill out a form on whether you want to rent or sell. And also, you're welcome to check out Chip Cagle at Longhorn Investments. He'd be happy to talk with you about fix and flip loans for your next investment. So thank you again for joining us at the Atlanta Landlord Luncheon, and we will see you next time. Thanks so much.
Bye. Thank you.